Hi, I'm Amy Short with Golden Visa Direct. If you're a U.S. investor in European funds or plan to be, this might be one of the most expensive tax risks you've never heard of. It's called phantom income. Income you owe U.S. tax on, even though you may have never actually received any cash. And with many institutional forecasts projecting a stronger euro against the U.S. dollar over the next year or so, that problem could quietly get worse for many investors. Let's look at how this works, why currency movements matter for U.S. tax, and what smart investors can do to plan ahead. First, the structure behind the problem, a passive foreign investment company, or PFIC. Many European investment funds, including the vast majority of Portugal Golden Visa funds, are PFICs under U.S. tax law. If you make a qualified electing fund election, or QEF election, you agree to report your share of the fund's income every year, whether you receive a cash distribution or not. QEF avoids the harsh penalties of the default PFIC excess distribution regime. The trade is that you can owe U.S. tax on income that still sits inside the fund. That's the phantom part. No cash, just a tax bill. Here's where currency enters the equation. Many PFIC annual information statements provide your figures in U.S. dollars. The fund's functional currency results are in euro, then the fund translates those results to U.S. dollar for the statement. If the euro strengthens, the U.S. dollar ordinary earnings and the net capital gains on that statement are larger, even if nothing changed inside the portfolio. A stronger euro can increase the U.S. dollar amount you must include, which increases your U.S. tax outlay. Think about it. The fund did not make more money. You did not receive more money. The currency exchange step made your U.S. taxable income larger. Major global banks, including JP Morgan, UBS, and Morgan Stanley, have published forecasts suggesting the euro could rise into the 1.17 to 1.23 range over the next 6 to 18 months. If that happens, the foreign exchange effect built into the fund's U.S. dollar reporting becomes more significant. Here's what that means in practice. The PFIC calculates its results in euro, then translates them to U.S. dollar for the PFIC annual information statement. When the euro strengthens, the same underlying earnings convert into a larger U.S. dollar figure on that statement. Imagine undistributed earnings of 10,000 euro at the fund level. Converted at 1.05, the translation produces about $10,500 in taxable income. At 1.20, that same 10,000 euro translates to $12,000 in taxable income. Your QEF inclusion rises because the fund's currency conversion produced a higher U.S. dollar number, not because the fund earned more or distributed cash. When you include QEF income each year, the ordinary earnings portion is taxed as ordinary income, and the net capital gain portion gets long-term capital gains treatment. That preserves character and can lower tax at exit from the fund. The downside is liquidity. If the fund does not distribute cash, you still need dollars to pay the tax. It's a clear tension: preserve character or preserve liquidity. When the fund does distribute cash, ordering rules matter. Amounts you already included as taxable income under Internal Revenue Code 1293 come out tax-free. Any distribution above that amount is treated as a dividend, and because it's from a PFIC, it's usually taxed at ordinary income rates. Remember your rate landscape. Under current legislation for 2025 as well as 2026, the highest ordinary income tax rate is 37%. Long-term capital gains rates are 0%, 15%, or 20%, depending on your income. For high-income taxpayers, that can mean paying 37% in tax versus 20%. For others, 24 or 32% for ordinary income versus 15% for long-term capital gains. If a distribution is expected, you will have euro in hand that you can use towards the US tax, and with a stronger euro, that may be a larger sum than you anticipated. If no distribution is expected, consider a 1294 deferral election. You can defer paying tax on undistributed Section 1293 inclusions until you receive a distribution or sell your investment. This isn't free, however. The IRS charges interest on the deferred tax. Still, it can align cash outflow with cash inflow. If this is relevant to you, speak with your tax advisor about the interest cost, the FX backdrop, and your liquidity needs. If you've not invested yet, plan ahead. Convert capital to euro while the dollar is relatively strong, and hold it in a foreign account until you invest. Or use a forward contract with an FX provider to lock a rate in the near term for your future subscription window. Either path reduces the risk of an unfavorable exchange rate later. If you hold euro abroad, remember your FBAR and possibly Form 8938 reporting requirements. Always confirm any currency strategy with your tax and investment advisors. The takeaway is simple. Exchange rates do not just move markets, they also move U.S. tax bills. For U.S. investors in PFICs, that movement can be expensive even when no cash changes hands. For a deeper dive on QEF elections, reporting requirements, and FX planning, join my Golden Visa Risk Masterclass at don'tgetburned.co to explore U.S. compliance structuring and tax impact through private client engagements. Visit goldenvisadirect.com. I'm Amy Short. Thanks for watching. Don't get burned.